Today we're going to talk about risk management and fraud avoidance. Some of our focus here is going to be on data and models. It's not so much IT as the underlying assumptions that go before the IT, or the data, not the technology. But we're going to think about that in risk management. Now, when we think about operational risks and risk management for fintech firms, one of the things we have to be aware of is model risk and risk management of risk in our data assumptions and our modeling assumptions. This could be true of algo trading, but it's also true of traditional markets. For example, JP Morgan faced this risk in model risk and the London whale phenomena. The London whale phenomena was an example of JP Morgan using some balanced models for risk trading and derivatives, and they were doing a lot of derivatives tradings to hedge positions and reduce risk. They were trading in a lot of positions, some long, some short, and arbitraging various things. But what happened is that other traders in the market began to realize there was a very, very large player taking large positions. And that person or individual working for JP Morgan became known in London financial circles as the whale. And the whale was taking larger and larger positions, partly in response with their models to arbitrage that they were seeing in the market, opportunities for taking advantage of market inefficiencies. But as they got more and more leveraged or more and more invested, their internal models said the risk was acceptable, that their positions long and short in different markets were netted out against each other and arbitraged. What actually happened is because of the size of their positions and the knowledge of other players that there was a huge whale increasing positions in some types of securities and not in others, the market started responding to the whale, not to the fundamentals. And the risk assumptions of the JP Morgan model started to not work. So the risk management tools used for protecting the firm against arbitrage risk were no longer working. The underlying assumptions of normality, the underlying assumptions of a variance not being skewed in a particular direction became less valid. We have to be careful of that in firms, particularly as we start to get higher leverage or larger positions. Our models may not work the way they thought. That can happen with algo trading. That can happen in highly volatile markets. It can happen in any market when our actions start to affect others' reactions. And so our market assumptions in our models may not be as valid as we thought they were. The market doesn't assume our actions in it. And so our algo trading or our derivative trading or our currency speculations may not fully reflect what we're doing to change model assumptions. Another factor that comes into play in operational risk is that risk deviation may be underestimated. In traditional banks, like in our earlier session, we talked about Deutsche Bank, where credit risk is high, market risk is high, but operations risk is lower, and business risk is low. That may not be true, and probably isn't true for fintech firms. Market risk may be much lower. Credit risk may be much lower, but business risk and operational risk can be huge. And the deviation can be much more than you might have traditionally thought. That makes for good news for fintech firms, and higher risk means higher volatility. More likely the stock price will boom, but more likely you'll go broke as well. So just be aware of that your risk derivation or derivatives are much larger in fintech than they are in traditional finance. That may be good, it may be bad. It just is riskier business. And when a large financial institution gets into riskier businesses like CDOs or other derivatives, that can cause big problems for the global economy. And so regulators have to worry about that as well. Fraud risk also increases with operational risk, and we see a number of examples of that. I already mentioned Barings, but Lehman going down with another risk of, I don't know exactly you'd call it fraud, but mismanagement or inappropriate actions by managers that create risk going outside of normal governance or objectives. We're not implementing what we wanted to implement as a firm. It's not credit risk, it's not market risk, it's business risk. And it's the risk that we may not be effectively doing what we should as a company or what we want people to do. And sometimes that happens for individuals. If we look at examples of management failure, there have been some big losses. Barings was over $1 billion in loss. That was a big loss by one trader, took down a 200-year-old firm. Enron was not a lot of people doing bad things. It was a few people behaving badly in ways that increase risk and cause compromise. Took down not only Enron, that was bad, but also took down an accounting partnership that had a long history, that had cooperated with Enron in some of their misrepresentation to investors. And so fraud can have big losses, not just for financial institutions or listed companies, but also for professional service firms that become subject to fraud, subject to management failures. McKinsey had failures, not on this list, but McKinsey had a failure that was quite painful and notable in South Africa not too long ago, related to some mismanagement and some inappropriate local management and controls, and McKinsey now has a chief risk officer. Many financial institutions have chief risk officers. Some are required to have chief risk officers to reduce risks of management failure, to reduce business risk, to reduce operational risk, because these sources of risks are increasing. We talked about Hammersmith and Fulheim causing not just risk for their own county of financial insolvency, but also risk for other firms doing business with them, because the management of that county, of that the government, didn't have proper authorities or permissions to do the trades that they were entering into. Orange County found themselves in a situation where their treasurer and their chief financial officer was making more and more money and doing very well in trading in derivatives. And this was good for Orange County, and their management was quite happy with their finance people making money year after year, and they made big bonuses. But then things went wrong. They made big bets that were wrong, and the outcome was virtual bankruptcy, very close to bankruptcy for Orange County, in a financial collapse that was devastating to the economics of that government because of inappropriate management and lack thereof. And part of the problem is that with J.P. Morgan, with Orange County, with Hammersmith and Fulheim, or Enron or Barings, as long as things are going fine, nobody worries too much about poor management or weak management control systems. And you say, it's okay, we're making money. And if it's only when a problem happens that you come in and say, you have exceeded our management guidelines, you've gone outside our risk parameters. Well, in fact, even the profits should be alarming to you. If someone is making a lot of profits and it's extraordinarily high, probably something is outside management control factors. And those are risks that are beyond what should be taken by the firm. Even if you win, if you're winning big and taking unacceptable risk, that's still not okay from a management perspective, of a risk management perspective. Society General, huge loss through poor management. UBS, poor management. Cathay Pacific, big loss, partly due to speculation that started out as hedging, started out innocently, but later led to some problems. And so we can see big losses resulting from poor management. This is a concern. And more banks and other firms in the finance area, including fintech firms, have to recognize that if you do not have good management controls in place, you are opening yourself up to huge failure and huge losses. And that is unacceptable. If you fail for business risks, some of that's unavoidable, but we can reduce risk by having effective management controls in place. In our next 2 weeks of this course, we're going to look at a lot of IT controls to help us reduce risk. But management controls are as important as IT controls or financial reserves to reduce risk as well. So don't neglect the people, the management, the policies, and procedures. Thank you.